Welcome to Breaking News to Trading Moves. Our mission today is really to look beyond the initial headline of one company's report. We want to analyze how that information gets processed across the market, what it means for related companies out there.
Exactly. And today, we're focusing on Uber's recent Q3 earnings report. And this one was, well, it showed a real split, didn't it? You had really strong consumer activity, great growth signals,
Yeah, it looked good on the surface.
but that was almost immediately countered by some pretty big worries about costs and future timelines. So the stock reaction, it really reflected that tension. Some companies got a boost from the news, others took a hit.
Right. So for you to follow the market moves, we need to look at the specifics of Uber's results, the growth part and the cost part. Then we'll break down the, let's call them winners, the companies that benefited from the good news on spending. And then the losers, the ones dragged down by those cost concerns and maybe delays in tech rollouts.
Yeah, you really need that foundation first. Otherwise, the way other stocks moved might seem kind of random.
Okay, so let's start with the positive momentum then, because Uber did put up some strong numbers on the top line. Revenue was up, 20% year over year, beat expectations there. And gross bookings were huge, nearly $50 billion.
$49.7 billion, yeah. And their guidance for Q4 bookings also looked pretty healthy, came in above what the market was expecting.
And a really key part was the mobility segment, wasn't it? That sent a signal.
Oh, absolutely. That was a crucial signal, actually. Uber reported its highest trip growth since 2023. Now, that's not just good for Uber. It suggests consumers are, moving around, traveling, maybe spending a bit more freely. That metric alone gave a bit of a lift to related sectors.
Okay, so strong growth, highest trips in a while. Logically, you'd think the stock would pop, right?
Yeah.
But it came under pressure pretty quickly after the report. So if consumer demand is that strong, why did these other issues overshadow it? Doesn't the market usually forgive minor bumps if the growth story is solid?
Well, the problem was these weren't seen as minor bumps. They were either very expensive one-offs or pointed to maybe more structural issues. Operating profit missed the targets, and the reasons Uber gave just set off alarm bells.
Okay, what was the first big reason?
The first was a very clear, very large financial hit. Uber booked a $479 million charge, and it was specifically tied to legal and regulatory matters. Now, for investors, that's often more concerning than, say, higher marketing spend.
Why is that?
Because these charges often relate to fundamental parts of the business model. Think gig worker classification, fights over operating rules in different cities or countries. That nearly $500 million hit just underscored how unpredictable and potentially expensive navigating those rules can be in the gig economy.
Okay, so a big unexpected cost right now. And the second point was more about the future, right? About autonomous vehicles, AVs.
Exactly. Management was quite explicit. They flagged that their big investments in autonomous vehicle tech are still years from profitability. That statement put a real damper on how investors value those long-term bets. It basically forces them to push out the expected payoff date, maybe by a lot.
Right, pushes the goalposts back. Okay, so let's shift gears now and follow how the market interpreted all this. Let's start with the winners. Despite that profit miss, Uber's strong trip numbers did create a positive read-through for some groups. Travel platforms seem like an obvious one.
Yeah, that connection is pretty direct. The thinking is straightforward. If Uber sees record trip volumes, it signals healthy travel spending overall. So companies that benefit from people taking trips, booking flights, hotels, they tend to get a bit of a positive sentiment boost.
So who specifically tends to move on that kind of news?
Well, you often see movement in booking holdings. The ticker is BKNG. It's seen as a good proxy for general travel demand. Strong ride trends often help BKNG. And similarly, Expedia Group, EXPE, same kind of logic. If people are spending on rides, they're likely also spending on other parts of their trips.
Okay, that makes sense. The next group of winners is maybe a bit less obvious. AI and AV infrastructure providers, including cloud companies. How did they win when Uber just said AVs are years away from making money? That seems like it should hurt them.
Yeah, it does seem counterintuitive, you're right. But this is where the market makes a pretty important distinction. Investors separated Uber's timeline for making profit from Uber's commitment to spending money.
Oh.
Management made it clear AV and AI are long-term priorities. They have to keep investing heavily. So even if Uber itself isn't making money from autonomous rides anytime soon, the company supplying the computing power, the sensors, the cloud infrastructure, they're capturing that spending now.
Got it. So the market's basically saying, okay, Uber is stuck spending billions on this stuff for years, and that money has to flow somewhere.
That's pretty much the read. The infrastructure providers are kind of insulated from Uber's actual service profitability risk, at least for now. So you look at companies like Alphabet, ticker GOOGL. They benefit, sure, from their Waymo partnership moving along,
Hmm.
but also more broadly, they're a massive cloud provider, a hyperscaler. They supply the kind of heavy-duty computing needed for AI training and running these complex models.
And what about the hardware side, the chips?
Oh, definitely NVIDIA, ticker NVADA. Absolutely essential there. You need their chips for the actual AV systems in cars, but also for the massive data centers doing the AI development. Uber's spending commitment basically becomes expected revenue for companies like NVIDIA.
All right, let's move to the third winner category. This one tied more to Uber Eats, the delivery enablers.
Yes. So Uber reported decent trends in their delivery business, and importantly, they mentioned improving margins there. That provides a nice positive signal for the companies that provide the tech infrastructure supporting the whole online food ordering world.
Right, the behind-the-scenes players. Who are we talking about specifically?
We're looking at companies that help restaurants manage online orders and deliveries. Think Toast, ticker TOST. They provide point-of-sale systems, integrations for delivery. When big platforms like Uber Eats see more volume, Toast systems handle more orders. And similarly, Olo, ticker OLO, they focus on managing the order flow, the delivery connections. They benefit directly when digital order volumes go up across the board.
Okay, so plenty of positive takeaways if you are focused on consumer demand and infrastructure spending. But now we have to look at the other side of the coin. The losers. For some sectors, that good news was completely wiped out by worries that Uber's cost problems, especially that big legal charge, weren't just an Uber issue.
That's exactly it. And that's why the first group of losers was rideshare and delivery peers. Uber's profit miss was directly linked to those legal and regulatory costs, remember. The market is incredibly quick to paint the whole sector with the same brush. The assumption becomes, if the market leader, Uber, is facing these kinds of headwinds, then the whole industry probably has similar vulnerabilities. So they price in that risk for competitors too.
So companies in the same boat facing similar rules and labor questions, they get hit almost automatically.
Pretty much. Lyft, LYFT, felt that pressure right away. Investors are already watching Lyft's path to profitability closely, so any hint of rising regulatory or labor costs, like those hitting Uber, makes them nervous about Lyft too. And DoorDash, DASH, also saw concern. The worry is that these kinds of legal costs, often tied to the worker model, could just be a recurring drag on margins for everyone in the space.
Makes sense. Okay, second category of losers. Near-term AV hardware pure plays. This seems like the direct opposite of the AI AV infrastructure winners we talked about.
It really is the other side of that specific coin. For companies that only make AV hardware, especially things like LiDAR sensors, their valuation often depends heavily on a pretty quick path to mass adoption. When a giant potential customer like Uber comes out and says, hold on, profitability is years away, it kind of shatters those near-term expectations.
Right. If the timeline for when they'll sell tons of sensors gets pushed way out, the present value of those future sales just plummets.
Exactly. It forces a repricing. It hits LiDAR suppliers hard. You saw names like Luminar, ticker LAZR, and AEVA, ticker AEVA. These are companies very sensitive to investor perceptions about how soon autonomous vehicles will really scale up and generate revenue. Uber's comment was a definite negative signal for that timeline.
Okay, and finally, the last group, the broader gig economy, high multiple name. Now, these aren't direct Uber competitors like freelance platforms. Why did their stocks get dragged down?
Yeah, this is more about a general flight from perceived risk within that whole gig economy category. When a major player like Uber flags a big margin hit because of legal or regulatory stuff, that $479 million charge, again, investors tend to generalize, they might decide to reduce risk across other gig-related stocks, especially those trading at high multiples, meaning their valuations already bake in a lot of optimism about future growth and margins.
So if one big gig company shows that the cost of regulation or labor classification is a real present danger, investors get nervous about any gig company that's priced for smooth sailing.
That's the thinking. High multiple stocks are vulnerable if the path to expanding margins looks suddenly bumpier. So you saw names like Upwork, UPWK, and Fiverr, FVRR, get caught up in this. Investors maybe decided to trim exposure to companies where margins might be more fragile than previously thought, given the regulatory headwinds Uber highlighted.
Wow. So this single Uber report really paints a picture of the whole market dynamic right now, doesn't it? You've got clear consumer strength, good news for travel, mobility, the platforms enabling that.
Yeah, the demand side looks pretty resilient. But then you have the reality check on costs, the cost of navigating regulations, plus these huge long-term bets on future tech like AV and AI. They're putting real pressure on profit expectations right now for a lot of these companies. It's that classic tension
Yeah.
for growth today versus the cost of tomorrow.
So as you're watching these market flows, maybe the question to think about is this. How much longer can the market cheer for high growth stories when they keep coming with these massive multi-year spending commitments for tech like AI and AV that might not pay off for a long, long time?
That's the tightrope, isn't it? Balancing the need for growth right now against the uncertainty and cost of future promises is what the market grapples with every day.
Thank you for tuning in to Breaking News to Trading Moves.
And just a reminder, this discussion reflects our opinions only. It is definitely not financial advice, and it's not a recommendation to buy or sell any stocks we mentioned. Please always do your own research and consult with a professional advisor before making any investment decisions.